I'm so pleased to introduce our first academic panel and to introduce my colleague and fintech expert, Sabrina Howell. Professor Howell is on the finance faculty here at Stern and also is a research faculty at the National Bureau of Economic Research. She'll introduce her panel and panelists, Manipulating a Bubble, 3 Dark Sides of Bitcoin and the Future of Public Blockchains. I would like to take note for the audience that this panel does have the ability to ask questions at the end. So please put your question in the Q&A and we will try to address them. Professor Howell.
Good morning, everyone. Thank you so much for having me. This is really a terrific conference. And I'm excited to moderate this panel. Our theme will be to discuss 3 dark sides of Bitcoin: manipulation, collusion, and lack of adoption. We're going to be talking to 3 financial economists about their research in this area. Crypto economics is still a relatively small area of academic research, but it's growing quickly. And we're lucky to have 3 academics who are among the leaders of this nascent field. So first, we're going to speak to Amin Shams from Ohio State's Finance Department. He is coming to fintech from the perspective of asset pricing and microstructure. Then our second speaker will be Christine Parlour, who is a finance professor at UC Berkeley. She has done a great deal of important research on crypto and comes to the topic from a background in banking and payments. And in particular is an expert about competition in financial markets generally, which is what she's going to talk about in the context of Bitcoin today. Then our final speaker will be Fahad Saleh from Wake Forest University, who focuses on the theory of blockchain economics. So we'll get started without further ado with Amin. So Amin, you have a recent paper published in the Journal of Finance, which is the top journal in financial economics, which received a lot of media attention, called "Is Bitcoin Really Untethered?" You start the paper by noting that periods of intense innovation and financial speculation are almost always accompanied by large-scale frauds and misinformation, and cryptocurrency is no exception. Your paper focuses on manipulation of the Bitcoin price via the cryptocurrency Tether. So can you start by telling us what Tether is and what purpose it and other stablecoins are supposed to serve?
Yeah, thanks, Sabrina. Thanks for having me on the conference, and it's a pleasure to be here. So Tether is basically a stable coin. It's a digital currency that's pegged to the US dollar. And stable coins in general have the benefits of a digital currency, but their value is much less volatile than other cryptocurrencies like Bitcoin. So these stable coins can serve as a relatively stable medium of exchange and a store of value, and they are often used as a base currency for trading other cryptocurrencies. And if you want to park your money in a relatively stable asset inside the crypto world, you can use stable coins. So overall, stablecoins can be useful instruments in these environments, but there are also important issues that we need to understand to fully grasp the role of Tether in the crypto trading environment. So first, Tether is the only major cryptocurrency, the only large cryptocurrency whose daily volume is larger than its market cap. So the trading volume of Tether is more than that of Bitcoin, Ether, and other major cryptocurrencies combined. So Tether is different from other cryptocurrencies in that it's being used as the primary base currency here, as the money in the crypto world for trading other crypto assets. The second difference is that unlike many other major cryptocurrencies, the supply of Tether is not mechanical or based on a predetermined protocol. Tether has decided the amount and the timing of the supplies in its centralized manner. Also, Tether in circulation was supposed to be backed by an equivalent amount of cash or fiat currencies held in a bank account as claimed by Tether initially, but this claim has been challenged by different people, including in our research and most recently by the NYAG, New York Attorney General. So Tether has actually revised that claim on their website and don't claim that they are fully backed by fiat currency anymore. So the bottom line is that the operation of Tether can work against the decentralized, trustless philosophy of the blockchain. You need to trust Tether to hold sufficient reserves. and you need to trust their centrally operated monetary policy. In this sense, I mean, you can say that Tether Limited acts as the central bank in the crypto world, but not necessarily a very transparent institution.
Thanks so much, Amin. That's a profound point, that trust plays an important role in crypto markets in practice, just as it does in conventional financial markets, despite sort of the theory of trustless finance. So now, can you explain in a little bit more detail how Tether was used to manipulate the Bitcoin price, which is really the key part of your paper?
Right. So I need to share a few slides here to just make sure we all understand the details of what was going on. So can you see the slides?
Yes.
All right, great. So our findings in general can be divided into two categories. First, I'll talk about the relationship between the flow of Tether into the market and Bitcoin prices. So given that blockchain data is public, we can actually observe all the on-chain transactions of Bitcoin and Tether, and we can identify the flow of Tether into major players into the market. And that's what we are doing here. So this graph shows a snapshot of all these flows of Tether during our sample period. The size of the nodes and the edges represent the volume, the size of the volume between these players. And what it tells us is that Tether is printed here at the bottom, at this red node. It's printed here at Tether Authorizer. Then all the Tether moves to Bitfinex first during our sample period, and then it's distributed to these Tether-based exchanges. I should mention that at the time, there was no USDT pair listed on Bitfinex, so you couldn't trade with Tether on Bitfinex directly. So the main venue for using Tether to buy Bitcoin and other cryptocurrencies were these Tether-based exchanges here. So this shows the Tether blockchain and the flow of Tether between these major players. But we also wanted to analyze the Bitcoin blockchain to see if there are corresponding flows of Bitcoin back between these players. And then given that flow, when Tether is distributed into the market, when it's used to purchase Bitcoin price, whether we see any price implications there, whether there's a meaningful price impact of the flow of Tether. So we turned into Bitcoin blockchain, but Bitcoin blockchain was much more complicated than Tether at the time. We had more than 360 million wallet addresses, billions of transactions, more than 200 gigabits of data at the time. And this is a 10-minute random sample of the Bitcoin blockchain. So each tiny dot that you see here is a wallet address. And the edges between these wallet addresses that you are not able to see probably, that shows the transactions. So we basically used algorithms to reduce the complexity of the Bitcoin blockchain and cluster wallets that are controlled by the same entity. I can talk about the details later if I have time. But after all these procedures, we end up with a snapshot like this. So this is Bitcoin blockchain. So we have these two entities, Tether blockchain. We can observe all these transactions and flow of Tether on Tether blockchain. We look at corresponding flows on Bitcoin blockchain, and we find a few interesting facts here. So first, we find that Tether goes from Bitfinex to these Tether-based exchanges. And in the same hour, Bitcoin goes back from these Tether-based exchanges to Bitfinex. So it's like Bitfinex or wallets associated with Bitfinex are using this newly printed Tether to buy Bitcoin from other exchanges in the market. And then the two flows, the flow of Tether out from Bitfinex and the flow of Bitcoin into the Bitfinex, they match very accurately in terms of the timing and the magnitude. And the flow is especially large when Bitcoin price is dropping. When Bitcoin price is going down, we see a huge flow of Tether and a huge corresponding flow of Bitcoin, especially when it drops just below round number prices, like when it goes below $10,000, when it goes below $8,000. And also the flow is largely driven by one large entity. It's a major wallet address with a lot of transactions. So most of the flow is driven by that single wallet address. which is associated with Bitfinex. And the aggregate volume of the flow here matches the total printed Tether closely. All right. So these are things that we see on the flow side. Then we look at what happens around the time that we have large flows of Tether into the market and large flows of Bitcoin back. So this shows a 6-hour window around large Tether flows here. This is hourly basis, and then the flow happens between time -1 and 0. Bitcoin price is declining before there's a flow of Tether. And then between time -1 and 0, we have a large flow of Tether into the market, and then prices reverse back in the next hour. So that's the first observation we had. And then we look at several robustness checks and various tests to see if the results hold. For example, if Bitcoin prices drop, but when there is no flow of Tether, we observe no reversals. We observe that prices do not go up when we don't have the flow of Tether. And we find that the aggregate impact is very large, and a big part of the price increase during the boom of 2017 is during these hours after the Tether flows. So basically you can come up with trading strategies based on the flow of Tether. So when you see a large flow of Tether, at least during that time period, if you go long on Bitcoin, prices are going to go up the next few hours. And our simulation results show that it's almost statistically impossible that these patterns are happening by chance. So this is the first set of results. The first set of results says that there is a strong relationship between the distribution of the Tether from Bitfinex to other Tether exchanges and Bitcoin prices. But what's the second set of results? The second set of results shed light on the nature of the printed Tether. So Tether can be printed in response to the demand from investors who want to invest their dollar in Bitcoin, but they convert their dollar into Tether first and then take the Tether and invest in Bitcoin. In that case, such price pressure could be just a genuine demand coming from people who have dollars or other fiat currencies, and they want to invest their money in Bitcoin. But they convert it into Tether first and then purchase Bitcoin using Tether. So there is a dollar reserve to back Tether in this case. And Tether actually showed some snapshot bank statements that showed the full reserve by Tether. So that was their narrative, that we have a full reserve of fiat currencies backing Tether. So let's see what happens around one of the times that they released a bank statement. And this is not, I mean, it happens anytime that they release a bank statement or they plan to do that, but I'm showing this as an example. So Tether released a bank statement, a snapshot as of September 15, 2017, that they have full cash reserve into their bank account. And what happens here is that Bitcoin prices suddenly drop by more than 20% in a few days before they show the bank statement, and then goes up right after that, the next day. This could be a coincidence, but we observe that almost any time that Tether shows a bank statement or plan to show a bank statement. But what does it mean? It means that it is consistent with Tether not having enough backup, enough fiat backup. They print Tether, they buy Bitcoin directly with that, and that creates an inflation in Bitcoin prices. But to make investors believe that each Tether is backed by $1, so each Tether is worth $1, they sell Bitcoin at certain points in time with a huge selling pressure that pushes the price of Bitcoin by more than 20%. So they raise cash by selling Bitcoin, they put it into the bank account, they take a snapshot, and then they go buy back Bitcoin again after that. So we observed this here. We observed this in other incidences that Tether issued a bank statement. And then this is a result that we had like 2 years ago. And then 2 years later, the recent NYSE report that came up a few days ago, it actually confirmed that Tether opened the account on the morning of September 15, 2017 here, and transferred the fund later that day. And the assets were verified as of 8 p.m. Eastern time on this day. So they opened the account here, and then this shows that the funds weren't there. So what does it mean? It means that Tether generally our results, like when you put together these two parts of the results are consistent with Tether being printed without a full backup, and Tether being used to buy Bitcoin, especially when Bitcoin prices are dropping, especially when it's dropping below run number prices, with a very specific pattern. And such oversupply of Tether creates inflation in Bitcoin prices. So if there was ever a run on Tether, like a bank run, or if enough people wanted to redeem their Tether to the dollar, or if there was a sudden drop in Bitcoin prices, which was backing Tether, then Tether might not have been able to satisfy the demand, and the whole system was exposed to a high risk of a collapse. So that's the bottom line of the paper.
Thanks so much. That was fascinating. Okay, so we'll move to the next speaker, and I have more questions for you, Amin, but we can perhaps come back to them at the end. And I also want to mention that for the audience, if you have questions, please note them down and ask them. And ask them in the Q&A function, and then we can answer them at the end altogether. So we'll now move to Christine. So Christine, in recent work, you document a dark side that has developed around fees in the Bitcoin protocol, which has been the most important public blockchain. Can you start by just quickly introducing us to the role of fees in the Bitcoin blockchain, just in case some of us are not familiar?
Sure. So the Bitcoin protocol, the way the system is designed, doesn't actually specify which transactions miners pick out of the mempool to incorporate in the blockchain. Because of this, there's an incentive for people who want their transactions to go through relatively quickly to make them more attractive to miners. And that's where fees come in. And fees are basically introduced as the difference between inputs and outputs in any transaction. And they're essentially tips or incentives for miners to process that particular transaction in advance of others.
That was a great and succinct explanation. Now, could you spend a few minutes describing how miners exploit this fee system?
Sure. So basically, what we found when we looked at the blockchain was we found some facts, and those facts put together come up with perhaps a plausible narrative. One, if you look at data on the blockchain, it turns out that it's not operating at full capacity. What that means is, if you look at the blocks, the transactions that are in the blocks, there's actually empty space, so more transactions could have been processed. This orange line represents average capacity use, and in different cases that can be quite high. But what to focus on is this red, which is the fraction of full blocks. Full blocks are rare and far between. Is this surprising? Well, the reason why it is surprising is fact number two. Fact number two is that there are transactions sitting in the mempool waiting to be processed. And what this graph does is it breaks down transactions by the fees that they're offering miners. So these are the highest fees and these are the lowest fees. And what you see here for each of these fee levels is a distribution of how long they wait in the mempool. In particular, the stylized fact is that higher fee transactions get processed more quickly, but they don't inevitably get transacted before lower fee transactions. So two things hopefully have been established. One, the blockchain does not operate at full capacity. Two, at any point in time, there's excess demand. So people want to get on the blockchain, but it's not working. So an implication of this is, well, you know what? If miners had taken one extra transaction out of the mempool, they could potentially have made more money. So you can actually look at the amount that was sloshing around the mempool that wasn't transacted and basically said, okay, well, how much money are people leaving on the table? Are miners leaving on the table? And this red line represents over time the amount of money left on the table. And it can be pretty substantial. This axis is in thousands of US dollars, and this averages over blocks. So there is money that could have been made that wasn't made. And so the question is, why would one do that? Well, why one might do that is basically to ensure that transaction capacity is a scarce resource. What do people do when faced with a scarce resource? They value it more highly. In particular, they'd be more willing to pay for it, and they're more desperate to pay for it. So artificially restricting capacity essentially makes people more willing to pay for processing, in other words, to pay higher fees. And indeed, the fact number 3 is if you look block by block, there's a tremendous cross-sectional heterogeneity in fees. On the left panel, this is just average across blocks, and it breaks down the different fees into percentiles. But perhaps more dramatic is the panel on the right, which shows the difference between the high fees and the very, very high fees, okay? So essentially what's going on here is because people think that capacity is scarce, or they know that they have to bid aggressively in order to get that scarce capacity, they bid more aggressively than they would otherwise. And a back of the envelope calculation suggests that almost $200 million were extracted per year from those who use the blockchain. So essentially, miners are artificially restricting capacity in order to increase revenue along this dimension.
That's fascinating. I think I now think Bitcoin has more in common with Verizon than we might have thought. One really interesting finding is that you can actually offer one reason why mining pools publicly sign blocks. Why might that facilitate collusion?
Sure. I mean, it's sort of like a price matching agreement, right? So if everyone is sort of understands that there's a gentleman's agreement or a lady's agreement, that they want to restrict capacity or make capacity a scarce resource, if you sign a block, that essentially says, hey, I did the right thing, I'm playing along. And so signing a block actually facilitates collusion in this game.
Yeah, super, super interesting. Okay, so I think we, in the interest of time, will move on to Fahad and then again, come back to questions where we can all talk together at the end. So Fahad, in a recent working paper that is joint with our Stern Finance colleague, Koos John, you speak to the question every skeptic asks about crypto. Why is no one using it in daily life? So can you explain the basic ideas that you propose for Bitcoin's limited adoption?
Absolutely. So let me actually put up some slides in order to do this. And I can offer, I think, this at a fairly high level. To start with the notion of why Bitcoin might not be widely adopted, I think is actually at a superficial level, a fairly straightforward question with a fairly straightforward and even obvious answer. And that's essentially the same answer as would be the case for any payment system, which is that consumers value speed and they value low cost. And a payment system that isn't going to provide them relatively good speed and relatively low cost compared to traditional alternatives like credit cards is not going to be a good competitor, and it's not going to be widely adopted. And so indeed, it is the case that Bitcoin is relatively slow and relatively expensive as compared to, for example, Visa. Now, that turns out, however, to be really the symptom and not the cause. And that's in part the point of this work with your colleague, Coach John, which is we go sort of one level deeper and we ask the question, well, why is Bitcoin slow and expensive? And essentially the main point turns out to be that Bitcoin's particular structure, practically speaking, imposes a constraint upon the speed of the system. And when you have a system that is a payment system that is constrained in its speed, you naturally get congestion. And when you naturally have congestion, what happens is you have an increase in the cost of using the system. So you have an increase in the fees that Christine was referencing. And so obviously slowing down the system or having a slow system directly leads to slow processing times, but it indirectly also leads partially to these higher fees. And just to provide some practical context for that in a maybe a more accessible setting, just think about when is it that Uber has surge pricing? It's not when the roads are completely empty. It's precisely when there's a lot of congestion, and you get congestion, of course, when the system is slow. Now, so this is basically a 30-page theory paper that sort of digs into why this is the case in Bitcoin, and unfortunately, I don't have the time to go into details of all that. But let me try to convey a little bit about what is special about Bitcoin structure by analogy. So let me offer you an analogy of a grocery store. And the reason I'm using this analogy is actually because in a grocery store, when you have congestion, which we said is a problem in Bitcoin, it doesn't tend to be a significant problem for a well-functioning grocery store. And I want to think about why it is that it is a problem with Bitcoin in that context. So in particular, if you're a grocery store and suddenly there are a lot of people who enter the store and need to check out, there's a very simple solution to this. The simple solution is that the grocery store is going to increase the number of checkout counters, increase the number of cashiers, and they're going to be able to essentially speed up their processing to absorb that additional demand, to alleviate the congestion, and to keep everybody happy, rather than people abandoning that store for some store maybe across the street. And to be clear, when I say that Bitcoin is effectively constrained in its speed, I don't mean it's a technical constraint. So it turns out it is actually pretty easy to, for example, speed up Bitcoin in a naive sense. So the rate at which these blocks arrive to the Bitcoin blockchain, for example, can easily be sped up. And so the analogous thing as increasing the number of cashiers at a grocery store, you might think of as increasing the speed of these blocks. And so then the natural question is, well, what's special about Bitcoin that this effectively increasing the number of cashiers doesn't actually work? And the key thing to understand is Bitcoin is a system that necessitates decentralized consensus. And what does decentralized consensus mean? Well, it means that all of the mining nodes that Christine was referencing, they must agree on a unique order of all transactions processed, right? They must have consensus on everything that is settled on this blockchain, or at least a vast majority of them must. And if you think of the analogy in the grocery store, the analogy would be to say, well, the cashiers need to agree on a unique order of customers processed. Now, that's absurd in the context of a grocery store. Cashiers in a grocery store do not communicate and coordinate on the exact order of customers processed across all of them. They actually work in silos and they do parallel processing. Cashier number 1 does not care about what cashier number 10 is doing. Cashier number 1 processes customers and cashier number 10 processes customers separately. And you can imagine what would happen if they actually had to communicate as they do in Bitcoin and to coordinate. One key thing that arises in this context is you think, well, okay, let's say cashier 1 processes somebody and it takes, let's say, 10 seconds to relay information about having processed somebody to, let's say, cashier number 10. Well, the thing is, in that intermittent 10 seconds, there's a chance that cashier number 10 processed somebody. And if cashier number 10 did process somebody, that means then that the order in which cashier number 1 and 10 will see the 2 customers that were just processed is reversed. They see information at different times, and they can have the orders then flipped relative to each other. And by the way, the more cashiers there are, the more likely it is they're going to see things flipped, right? Because the more time that is going to need, because that means there's going to be more time that elapses in order for them to communicate the information across the network. And so in Bitcoin's case, this communication time is something referred to as network delay, which is just the time it takes to propagate information across the network. And the more decentralized you are, the more of a constraint this is, and the more confusion it's going to cause, basically, when you try to get consensus. And so essentially what's happening in Bitcoin is it's like you're forcing these cashiers to communicate and coordinate and come to agreement on a single unique ordering of customers process. And so maybe at first when you speed it up a little bit, it works. Like maybe a few more extra cashiers are going to alleviate congestion a bit. But what turns out to be the case, that if you increase the cashiers by too much, if you like, you actually cause more confusion than anything. And you don't actually get faster processing times because the cashiers are spending too much time just trying to figure out who was first in order to process people than actually taking people. And so this turns out to be kind of the key distinction. And it's not something that we see in centralized payment systems. Centralized payment systems have the ability, in effect, to absorb the demand, to alleviate congestion, and to continue to operate efficiently at very high scales. Bitcoin, unfortunately, does not because of this particular structure. So I think that is a super high level, version of the work I have with COS. And I welcome everybody to go and take a look at the paper online if you're interested in the map.
Thanks a lot, Fahad. I like the grocery store analogy. That helps me as a non-theorist to understand better what's going on. Can you speak a little bit about the ability of the alternative proof of stake consensus mechanism to resolve some of these problems with Bitcoin? I know you've worked on that in other projects. Can you say whether you think that also has this sort of fatal flaw?
Sure. So yeah, proof of stake is a very interesting idea, and it's actually a little bit heterogeneous. The short answer is yes. It's actually one of the reasons it's an extremely compelling idea is precisely because at least versions of it allow for parallelization of the blockchain. So one of the key things in that analogy to the grocery store is precisely that in practice at grocery stores, the cashiers can do parallel processing. And in the world of blockchain, when it comes to proof of stake, the term here is sharding. So for people who are familiar with Ethereum and Ethereum 2.0, which is Ethereum's transition to proof of stake from the protocol that they were using before, or the protocol that they're still using, but one that Bitcoin also uses called proof of work. One of the key motivations for them is precisely that they will, or they expect to be able to parallelize the blockchain. So proof of stake is very compelling in that regard. Another interesting thing that some other versions of some other incarnations of proof of stake are able to do is let me offer you a slightly different analogy in terms of trying to sort of organize and get things done in cases where it's difficult and how to deal with decentralization, which is that, we don't have a direct democracy really anywhere in the world. We don't all vote on everything that the US government, for example, is doing, but that doesn't somehow stop us from getting things done. That doesn't mean Congress gets a lot done, but the point is, it's not the fact that we all have to weigh in on every bit of legislation, right? And so the way we get around that in practice is we have Congress and we have representatives. And so it turns out proof of stake, one of the incarnations of it, is actually able to do something very similar, where it allows everybody to weigh in, but it allows them to weigh in indirectly, in much the same way that we indirectly weigh in on our governmental processes in a democracy. So proof of stake, I think, is a very interesting and compelling idea. And one of the big motivations for it is actually that it is supposed to be more effective in scaling.
Interesting. That's really helpful. And then as a last question for you, what are some alternatives to the network delay that you think poses such a problem? Like, if you could wave a magic wand, is there a solution?
There are lots of solutions that are proposed. So the unfortunate thing, first of all, is that with network delay is that it's a practical constraint that exists. You can speed up computers, but you can't speed them up past a certain point because we have physical constraints. And so usually when people are trying to get around it, Because remember, you have to have, if you want the initial vision of Bitcoin, you're talking about having to deal with a scale on a much higher order than Bitcoin currently tolerates. So this is really in part a question of, at that scale, are physical constraints going to be relevant? The truth is they probably are. So that means that you probably have to go to things like proof of stake to resolve it. And in that regard, I think one of the big takeaways from my work with your colleague is actually that Bitcoin is not an effective payment system at scale. And so the token on it, the unit account on it, is not an effective currency in a globalized sense. And so maybe we should be thinking about Bitcoin, instead of thinking of it as a currency, we should start thinking about it as, for example, a commodity, where it might be more appealing relative to what's out there.
That's a very, I think, powerful idea. And I'd like to build on this, moving to a little bit of sort of a lightning round of questions that I'll ask the whole panel before we move to the Q&A from the audience. And in particular, I'm curious generally, just sort of as experts in this area, for your thoughts on whether public blockchains should be regulated. And, if at all, to resolve these problems. So do you sort of see these problems that you've described over the course of this panel as challenges that the decentralized system should just be sort of left to resolve on its own? Or do you see there being a role for government in coming in and trying to prevent manipulation as regulators do in other, commodity and currency markets? And so here I'll start with Christine, if you don't mind being my first victim.
No, fine. The community is actually pretty good at coming up with solutions when they think that there's a problem with a specific blockchain. So we've seen a plethora of new models, new staking models, and essentially new speeds, much faster blockchains. So I think the community in and of itself is going to come up with solutions, and different blockchains are good for different things. And so the one size fits all is not really a characteristic of this part of the economy. So I think government has absolutely got no role.
Okay, that's certainly a strong view. Amin, what about you?
So I agree with Chris in that when it comes to decentralized blockchain or decentralized systems in this environment, probably regulation is not a good idea. But when it comes to these centralized players here, like we have centralized exchanges, centralized authorities like Tether, I think then we have these large institutions that are not necessarily very transparent, regulating them with a focus on transparency. So that I think should be the focus. To bring transparency to these central authorities, I think that could improve the trading environment, at least, of these cryptocurrencies.
Okay. And then finally, Fahad, do you have a view on this one?
So I would take the view, I think, in line with what Amin was saying, which is that I do think there is some role for regulation on some level, and there is a level of, for example, mistrust that may drive the collapse in the ICO market that could be helped by a little bit of regulation, for example, I think. And one analogy to think of is, when you go to the grocery store, there's a lot of freedom in terms of what can be put on the shelves, but it's not like you can put poison in the milk aisle. And so there is, I think, some advantage to just a little bit of regulation. But of course, given that the setting is sort of motivated by a lack of trust in centralized institutions, you don't want to overdo that.
Well, that certainly makes sense to me. No poison in the milk aisle. So, okay. So now I'd like to spend the rest of our panel, we have a little over 10 minutes, on Q&A. And we have a number of great questions from the audience, and I encourage you all to keep asking them and entering them. I'll just, pick a few to answer. And the one I want to start with is from James Cho, who asks, this is for Christine, if miners are allowed to restrict trading so that they can prop up the transaction fees, why haven't transaction fees gone high enough to make it sort of unsustainable? Or is there sort of a natural supply-demand equilibrium that has emerged where the fee structure is maintained as sort of what is perceived as a healthy market level? Can you speak to that a little bit?
Sure. I mean, we have to remember that the Bitcoin system is essentially a clearing and settlement system. So if you want to swap out of your Bitcoin position, if you want to transfer value, in DeFi, there are lots of different ways of doing it. And basically, the existence of alternate ways of transferring value implicitly put a cap on how much people are willing to spend to actually go through the Bitcoin system. So competition basically is restricting the amount that people are willing to spend. And I think had there not been this explosion of DeFi, we might have seen very, very different price dynamics. But given that we have, that puts a cap on how much people are willing to pay.
I see. Okay. And I want to ask you one more question from John Haslanger, who asks, how much impact does the backlog of transactions in the mempool have on the block size or the number of transactions that are, that are included by the miners? Do you find that there is a correlation between the mempool queue or trading volume and the block size? And if there is a correlation, what is causing it?
So the thing to remember is the mempool is node specific. There is not one mempool. Mm-hmm. So to do some sort of analysis like that, you'd basically have to look at every miner and their own mempool. We don't see miners' own mempools. We just have information on what we think is sort of the aggregate. Right? It does appear to be the case that when more high fee transactions are in the mempool, more get processed because the probability of being processed if you have a high fee transaction is higher. So that appears to be in the data.
Mm-hmm. Yeah, that's really interesting to try to understand how all of this is operating. Okay, so we have a few questions for Amin as well. And one I want to start with is from Gavin Kilduff, who asks, I am wondering if Amin can estimate the extent of inflation in Bitcoin's price as a result of the Tether dynamics that you described. I noticed that Tether's market cap is about 4% of Bitcoin. And does this suggest that the extent of inflation is relatively small?
So I don't believe so. The reason is that the trading volume of Tether is massive. Trading volume of Tether is more than double trade volume of Bitcoin. So when it comes to money, we care about velocity. So the velocity factor of Tether is actually pretty high, and that makes the price impact very high actually on Bitcoin prices. Another factor that we need to consider is that not all the Bitcoin, not all these $1 trillion worth of Bitcoin is trading on exchanges. So given the liquidity, there are estimates that maybe there are around like 2 million Bitcoins or less on trading exchanges. So given that liquidity, the price impact could be different. But we have some estimates actually in the paper. During our sample period, the return of Bitcoin over that one year, like 13 months in our sample period, the return was more than 500%. And if you remove top 1% of hours with this high flow of Tether, then we do some simulation, we replace those hours with any other types of hours in our sample period, the return would be almost 200% instead of 500%. Even by removing that 1% of the events on a predictive base. So we remove the next hour when there's a flow of Tether. So the price impact is actually pretty large because of the velocity of Tether.
That's really interesting. So I'd like now to talk first to Amin and then to Fahad about the recent surge in Bitcoin prices, which has brought crypto markets, I think, to the attention of everyone, including my grandmother in Florida, who is now trading alternative tokens, which I find entirely frightening. And so I'm hoping, Amin, that you can answer James Cho's question about whether the recent surge in Bitcoin price is also linked to Tether, or whether Tether is perhaps because of better behavior and more supervision is sort of no longer manipulating the Bitcoin price?
I mean, I haven't seen better supervision or better behavior from Tether, so that's that part of the question. But on the other hand, I don't want to speculate on that because, like, if you look at our study for 2017, it's like 100 something pages of academic study. We look at detailed data, we look at detailed blockchain data. So I don't want to answer that just based on a speculation, but I can tell you that Tether's behavior, I don't see a major change in like transparency of Tether or any other behavior.
Okay, so should we take that to mean that although you may not be working with the data now, it is entirely possible that Tether is in part behind what we're seeing in Bitcoin in recent months?
It is possible, yeah.
Okay. Fahad,
I mean, not entirely because there are other events going on as well. Institutional investors are coming to the market, but I cannot reject that Tether has nothing to do with it.
All right. Now, Fahad, can you perhaps speak to your perspective on what explains the recent run-up in crypto market prices, in particular Bitcoin?
So I try not to predict the daily gyrations in any particular asset, but let me offer some broader context in my view about sort of, let's say, valuation on Bitcoin. And I think this touches upon what I was saying earlier, which is I think sometimes people have perhaps the wrong context in terms of thinking about the value of Bitcoin. And it comes from the notion of, again, it's a pretty lousy currency. But if you want to put it in context of commodities, Bitcoin's current valuation, despite the fact that it's near all-time highs, is 1/10 of gold. And we have survey evidence now that younger investors are starting to think of Bitcoin in the way that older investors think of gold. And before you laugh at that too much, I want to remind everybody that actually, if you think about gold is a commodity that has minimal industrial use. So if your argument is like Bitcoin is not all that useful in the first place, well, neither is gold. It's a shiny object, and Bitcoin is a shiny object too. Both of them are not supply-wise controlled by a centralized entity. Both of them do not have discretionary monetary policy. And one difference, of course, here is that Bitcoin doesn't have the storage costs that gold does. So in one context, people obsess about, Bitcoin's at 50,000 and $1 trillion in market capital, but put that in context of where gold is and tell me which one is mispriced.
I absolutely agree with the analogy you make between the two. I'd like you to answer another kind of broad question from Mathieu Mingasson, who asks, your thinking is based on the assumption, and this is referring to your paper, based on the assumption that technology will always be a barrier and will undermine Bitcoin's ability to process transactions quickly. But looking back at the history of computing and network technology, all we see is an exponential increase of processing speed. So what are your thoughts on the evolution of technology in the next 10 years in terms of potentially addressing that core problem?
Right. So I think a key thing to put in context here is that there is technology in terms of processing speed, but there's also physical constraints in terms of the amount of time that it would take to send a certain amount of information a certain distance. Right. So, for example, these are constraints that we see as binding in high frequency trading markets. But in high frequency trading markets, you can have a whole bunch of people decide to just put their trading shops right there near the stock exchange. Bitcoin being a decentralized environment where people are particularly looking for cheap energy, they tend to be a little bit more spread out. And so you have to really think about at the scale that you would need to compete with, say, Visa. Is it viable, even if you assume that processing speeds are basically infinitesimal, which, by the way, you have specialized computing units that are basically doing this mining, right? And it's important to realize mining is an artificial exercise. So the difficulty of the problem is a free parameter. It's not really that's the binding constraint. The point is that in order for this to work, you basically need the network delay to be less than even seconds, right? And that's going to be an issue when you have people spread across the world that are sending information to each other. So particularly given that we have useful payment systems, effective payment systems, that's a pretty high hurdle to get over because you actually have to convince people to drop Visa and start using Bitcoin, which means that Bitcoin has to be considerably better than Visa, not just a little bit. And it's not anywhere close to being as good as Visa right now. So I'm not too optimistic on that dimension.
I see. All right. Well, we'll have to end it there. Thank you so much to all the panelists and to the questions. I encourage you all to look up these professors' research on their website and learn more. And with that, I'll hand it back to Kathleen to introduce the next panel.
So that was amazing. There was so much substance there, and you can kind of see why Visa, MasterCard, PayPal have all entering the crypto payment space. And you can also see the imperative for governments and sovereign cryptocurrencies to get involved. Great panel. Thank you all so much. Fantastic.